operating versus a sales lease. On January 1st, 2019, Nelson Company leases certain property to Queens Company at an annual rental of $60,000 payable in advance at the beginning of each year for 8 years. The first payment is received immediately. The leased property, which is new, costs $275,000 and has an estimated economic life of 8 years and no residual value. The interest rate implicit in the lease is 12%, and the lease is non-cancelable. Nelson had no other costs associated with this lease. It should have accounted for the lease as a sales type lease, but mistakenly treated it as an operating lease. Compute the effect on income before income tax during the first year of the lease as a result of Nelson's classification of this lease as an operating rather than sales type lease. Round to the nearest dollar, and then we just have this blank area where we can input our answer. Make this blue. And so let's just calculate under the operating versus the sales type, and what the income before taxes would be, and then use that obviously to subtract the difference. So for an operating lease, we'd be looking at rental revenue less depreciation expense, and that would give us income before taxes. And so we have rental revenue of $60,000 and depreciation expense are $275,000 divided by 8 gives us $34,375. And again, it said that this had an 8-year economic life, no residual value, and it's straight line. So that's how we calculate the depreciation expense. And so the income before taxes would give us $25,625. Now we'll do the sales type lease. And so that would look a little bit different because we would have sales and then the cost of asset leased. And that'll give us a gross margin. And then we'll add the interest revenue, and that'll give us income before taxes. And so our sales is going to be the present value of those payments of $60,000. So we'll say equals present value, open or PV, open parentheses, rate is 12%. There were 8 years, so 8 periods. Payment is $60,000. And then we need to do the beginning of year type. So we need to put comma, comma, 1 to indicate beginning of year, close parentheses. And I'll put a negative sign in front of this so that it displays it as a positive. $33,825. And I guess technically we should do a round function in front of this because it told us to round it to the nearest whole dollar. So I'm going to add that function in. The cost of the asset is $275. So that gives us a gross margin of $58,825. Our interest revenue is going to be equal to our, let's do a parentheses here, our sales of the $333,000 minus 1 payment of $60,000, close parentheses, times the 12%, and we get $32,589. And then we can subtract the $58,000 minus the $32,000 for income before taxes of $25,966. And so what was the effect of income of the lease as a result of the classification as an operating rather than a sales? Oh, I'm sorry. I shouldn't have subtracted this. I should have added these, because that's interest revenue. So So we should have recorded 91,000, but we did instead record 25,000. So if we just use the difference here, 91,000 minus the 25,000 gives us a $66,059 understatement by recording it as the operating rather than the sales type lease.